Okay, hey guys, this is Ernest Joseph. Yes, I'm going to be your coach for today. What we're going to do, we're going to do something different for you guys. This is not going to be as as funny as the all the videos that we put for you guys. This is 10 questions. So I'm trying to see if I can help you guys really to understand how do you can pass that exam. Okay, so that's the reason there's 10 questions that I'm gonna do for you randomly. Okay, I'm gonna give you maybe 5 seconds. Okay, because while the question is in there, you can take a moment so you can read it. I'm gonna give you the time so you can pause the video. You can pause it so you can see if you can answer the question yourself. Then I'm gonna do the best that I can to see if I can help you point out why this is the right answer. Okay, because some agent have a little problem with answering the test question, because sometimes for whatever reason they have a tendency when they go to answer the question but they missed it. It's after they missed the question and they ask me, well, you did cover that information, but for whatever reason I didn't get what the question really asking. Okay, the way you're gonna know what you just learned is how you answering the questions. Okay, and I'm gonna explain to you also why it is the right answer in case you missed it. All right, I'm just gonna do 10 questions so the video don't be too long. And if you like it, just give it a thumbs up, and I give you the permission. You can share it to one of your partner, somebody else that that's maybe learning something from this, going to take the exam, maybe that can help them understand that material better. Okay, so those questions will be random, so I'm not gonna go in any particular order. It's just like those questions just gonna pop up, then we're gonna go over to them. So if I did go to the first slide, maybe you could see better. So that's what I should do, but my screen was not set up for the front. Okay, so you can see 10 random question, so you can see it. Okay, and I also want to say thank you to all of you guys that like the videos first of all, and all of you that's come in and keep learning, and that's how you keep us encouraged to do it. The reason I'm doing this is just like I just want to help people, because I remember at some point it was me. So you didn't know too much about me, but I took that exam 3 times before I passed it on the 4th try. Okay, so that's the reason I do the best I can to see if I can help you pick a couple points on that exam, if that will help you. All right, so let's go ahead, get started. Let's go to the first question. This question, because I'm gonna read it so you can have time to just give you like 5 seconds so you can pick the answer. So the question said, what describe the specific information about a policy? What describes the specific information about a policy? A, buyer's guide. B, producer's report. C, policy summary. And D, illustrations. Now, when you get that question, I want you to think, what they ask, what is the key word into that question? The key word on that question is specific. Once you see the word specific information, okay, it's just like, let me give you an example. If let's say there's a group of men into a room, okay, and if I just say men, and there's 10 men inside that room, how would they know which men I'm referring to? All the men gonna look at me, I'm crazy, okay? But if I say Ernest, but because Ernest is in the group of 10 men, so I'm being specific because I mentioned exactly the person I'm referring to. So that's what that's asking you. In the policy, there's some information that's specific, but you need to know what those are. For example, the premium amount, the surrender charge, those are specific. The company name, when is the premium is due, when you have to make that payment, how much is going to be the cash value. So it's like being give you specific information. But the opposite of specific is general information. So if you see the word specific, that referring to the policy summary, hopefully you go ahead, you pick policy summary. So I hope that's what you pick. And this is the right answer. Policy summary. So as you guys can see, I hope you can see it. It's C is the policy summary, because the policy summary, it tells you specific information. When do you give that summary to the person? Is when you deliver the policy, you give them the summary. It's telling them specific information about the policy. So don't confuse policy summary and the buyer's guide, because the buyer's guide is give you general information, not specific information. Now, producer's report, don't confuse with that as well. Let's go to the next question. So next question. Say that all, now you see, this is all of the following information about customer must be used. Nothing, all of these are true. There's one that's not true. So all of the following information about the consumer must be used in determining annuity suitability. Okay, so now, except, so that suitability, you need to know what suitability means. Annuity suitability, that's the keyword. Okay, so annuity suitability, you have to know, is it suitable? Is it that product, when you refer that part of the discount, is it suitable? That's what you have to understand. That's the keyword. Annuity suitability. So suitability, you find suitability in different products, but they're talking about a specific product, annuity product. If you didn't watch that video, go watch that section so you can see. Now, let's see what's not important. So what they're saying is, which one of the following is not important? So that's mean all of the following are important, but there's one that's not important. A, beneficiary age. B, tax status. Okay. C, financial experience. And D, annual income. So now this one asking which one is not. Oh, let me clear this out. My bad, I didn't see this. Okay, let me clear that. Sorry, my bad, I didn't see this. My bad, because I just started using this, so be patient with me here. Okay, apologize because I didn't select one yet. Okay, so suitability. So it's telling which one is not important. So I give you plenty of time. While I'm reading all that, give you all that information, you should be able to see which one is the right answer. So which one is not important? So tax status, of course, you need that. Financial experience, you need that. Annual income, yes, to determine if that product is suitable for the client. But what does the beneficiary age have to do with anything? Why don't you go sit your little down and wait for your money? You're the beneficiary. Go sit down, wait for your money. That's what that is. So beneficiary age, that's not important. Okay, that's not important. So let's go to the next question. So give me time so I can clear it out. So that's how I can do it. Yes, good. Clear it out. So next question. Okay, so the next question that we're going to talk about, and if you come in, okay, so if you're coming right now, you're just going to have to, somebody is probably coming right now, you're just going to have to stay muted, because I'm just recording a video. So just don't say anything, just stay, don't say anything, just mute yourself, stay muted, because I'm just recording a video. So while I'm doing those questions, so you can see how we're doing this. So I'm glad you come in, because I don't know, you just pop up. So great. You're going to get some training right now. All right. So the next question asks, all of the following would be different between qualified and non-qualified retirement plan, except. So again, this question, I say all of those things are true. All of those things are differences between qualified plan and non-qualified plan, except. Now, what you need to know the difference though between qualified and non-qualified. Just let me help you a little bit. Qualified plan, it have to have the IRS approval. It must be in writing. It must be permanent. It cannot be temporary. And you have to communicate to everybody, okay, to all the employee. They have to be in the benefit of the employee and the beneficiaries. But non-qualified, they can discriminate against people. They can pick and choose who can participate in that plan. Okay, that's why it's non-tax deductible. But while qualified plan is tax deductible. So you need to know the difference. You need to know which plan that falls into that. I'm not going to go through all that details right now with you, but you need to know the difference between qualified and non-qualified. So if you go to a test question, you find qualified and non-qualified, and the keyword is qualified and non-qualified, you need to know what's the difference. So let's go ahead and take a look at that. So now you see this number changed. Okay, 1, it said that taxation on accumulation. 2, taxation on withdrawals. 3, taxation of contributions. And 4, IRS approval requirements. So let's start from down. So now the way you answer that question, teammates, let's see if it is true. Is it the same or is it different? IRS approval required in which plan? Qualified plan. Non-qualified, it doesn't. So therefore, that's the differences. So that's not what you're looking for. Taxation and contribution. Qualified plan, they don't tax you until later. But non-qualified, you pay taxes first. So therefore, that's the difference. That's the difference. So it's not 3. Number 2 say taxation and withdrawal. If it is taxation and withdrawal, let's see. We can think about this one. Taxation and withdrawal. So if I have a qualified plan, when I make a withdrawal, do I have to pay taxes? Yes. If it is a non-qualified, do I have to pay taxes? You do have to pay taxes, but not really just on this, the withdrawal, on the basis, on the cost basis, excuse me, the cost basis is not taxable. It's on the growth. You can pay taxes on the growth. Okay? Taxation accumulation. So you see, there's a different taxation accumulation. If it is a qualified plan, when the money accumulated, do I have to pay taxes? When it's accumulated, no, I don't have to pay taxes. No, I have to pay. No, accumulation. No, when the money accumulated in both plans, I don't have to pay taxes. So that's mean 1 is the right answer. So they're the same. So you don't pay taxes when the money accumulated. Okay, you don't pay taxes on that. When you accumulate money, both of them, you don't have to pay taxes. But on the withdrawal, you pay taxes. Okay, there's a difference in here. So accumulation, taxation on accumulation. Okay, both of them can grow tax deferred. Okay, they're not tax deductible, but they can grow an accumulation tax deferred, and they can pay the taxes later. So make sure you get that. Let's go to the next question. So remember, it's 10 random question. So let's go to the next one. Okay, let's see the next. Go ahead. Okay, it didn't change. Let me see if I can change it here. Okay, let me clear that out. Okay. So let's go to the next question. Here's the next question. They say, which non-forfeiture option has the highest amount of insurance protection? Okay. Now let's see this. Now you need to know there's 3 non-forfeiture options: reduce paid up, extended term, and cash surrender. Now this is the key word on this one. Say highest amount of insurance protection. Highest amount. So one of the non-forfeiture options cover you for the highest amount. Then we need to know which one. Now, if you go to this question, that's 1. Decreasing term. Does decreasing term, ask yourself that question. Is decreasing term a non-forfeiture option? No. You look at my head. No, it's not. Reduce paid up. Is it a non-forfeiture option? Yes, it is. Extended term. Is it a non-forfeiture option? Yes, it is. What about conversion? Conversion is not a non-forfeiture option. Conversion is a feature you find into a policy to convert to a whole life without proof of insurability. So therefore, 4 and 1 is eliminated. So now you only have 2 choices to pick from: reduce paid up and extended term. Now, the answer to this question is extended term, because the extended term is covered for the highest amount of protection, because it's covered for the same face amount as the whole life, except it is a term policy. It's not a whole life, but it's covered. Let's say, for example, if you have a whole life policy that covers you for $100,000, but you have $20,000 in your cash value, so you use that $20,000 in your cash value to buy the same $100,000 whole life policy you have, but as a term policy. So you still cover for 100, except it's a term policy. Except it might cover you for like maybe 10 years and maybe 30 days or maybe 365 days. So therefore, this is what happened. Okay, if I say 265 days, that's messed up, but 360, let's say 63 days, but to make it better. So it's not, so that's the amount of time, the length it's gonna last you. But it covered for the highest amount because it's covered for the same face amount with the whole life. But now, be careful. If they change it, witness for future option has the longest, instead of highest, they say longest amount of protection. If they say the longest, then it will be the reduced paid up because it will cover you for the longest period because it's going to cover you for your whole life. So it's the longest period that will be the reduced paid up. Hopefully that makes sense. That's a good test question. Heavily tested. All right, let's go to the next question. Let me clear, okay? Let me clear this out because every time I got to clear that. Be patient. Next question say, which of the following is not fundable by an annuities? So which of the following is not, okay, fundable by annuity? So that the keyword is annuity, that's a word. You have to know what's the difference between annuity and life insurance in this question, okay? Not fundable. So there is one thing here that's not fundable by an annuity. So let's go ahead and see this. So be careful, okay? There's some stuff here that's not part of annuity. There's one thing that's not an annuity. It's part of life insurance. Just give you a clue. One, a person with retirement account. Okay, would you agree when somebody buy an annuity, it's to fund retirement account? Yes. So that's not what you're looking for. State liquidation. Oh, yes, you can do that. Death benefits. Death benefit. Death benefit is something you find where? Life insurance. Of course, life insurance, you find that. Cash accumulation for any reason. Yes, you can do that in an annuity. But death benefits, it's something we deal with when we call into a life insurance. That would be the correct choice for this question. Okay? We're moving along. Let me go next and let me clear to erase it. All right. So this is the next question. Which of the following types of insurance would be written by a limited line agent? Okay. Which type of insurance would be written by a limited life? So that's mean that's a limited life. That's mean you don't have a full life. That's when somebody can do that. Okay. So let's go. One, surplus line insurance. No, not that. Two, term and life insurance. Oh, you need to be really licensed, not limited. Credit life insurance. What is a credit life insurance? Okay, this is something where when you go buy a car and they say, hey, you need to get life insurance to protect in case something happens to you. So they can pay the car off for you. Or maybe you get a mortgage. They can make you buy credit life insurance to protect the lender. Okay, so that sounds like it. Let's with the next one. 4, variable life insurance. Oh yeah, you need to be fully licensed, not limited line. So therefore, in this one, the limited will apply to credit life insurance. All the other one, you need to have a full license. Okay, good. Moving along. Moving along. Next, let me clear that out. As you know, next question. Which of the following statements is not true concerning insurable interests as they apply to insurance? Okay, now the keyword is insurable interest. First of all, you need to know what is insurable interest is. If somebody die, it's gonna affect you financially. That's when you can put insurance on that person. That's a financial impact. If let's say if I don't know you, you pass away, I'll feel bad. You can say, man, this person was, get their license, they were listening to your video, and then they just pass away after they just passed the exam. I feel bad that happened, but it will not affect my money. It will affect your brother, your sister, your mom, your dad, maybe a business partner, maybe your wife, maybe your husband, maybe your kids. Okay, maybe if you are a key employee to an employer, you will affect them. Maybe if you owe people money, you're a debtor to a creditor, you will affect their creditor. So therefore, those who have insurable interest, what they're saying is who have insurable interest. If I can put it this way for you, this question asking who have insurable interest. From all this list, from all these answers, 1 to 4, there is someone here that do not have insurable interest onto the other one. That's what pretty much what this asking. Okay, but now there is one of them that's not true. Let's start from number 1. Number 1 say a husband or wife has insurable interest in their spouse. Yes, because that's why if you married couple, your husband can put a policy on you, you can put a policy on your husband. So therefore, that's you guys have insurable interest. So that's not what you're looking for. You're looking for the first statement. Number two, an individual has insurable interest into his or her own life. Well, you bet that's why you can buy a policy on your own self. So that's when you have insurable interest on yourself, because if you die, he will affect your money. Okay. Number three, a debtor has insurable interest into the lender. Now, if I don't want to say debtor, I can say a borrower. If I don't want to say lender, I can say a creditor. So if they change those words, don't be confused. Now, this is a first statement. The debtor never have insurance into the lender. It's the other way around. It's the lender has insurable interest into the debtor. So you need to understand that. So the people who borrow money, the lender, the creditor has insurable interest into the debtor or the borrower. So you need to know three is a false statement always. If they say the debtor has insurable interest, that's not a good statement. Number four, let's read it anyway. Business partner have insurable interest in each other. Yes, they do. Think about it this way. Somebody say, well, there's no way that high business partner have insurable interest in each other. Think of it. Let's say you and I put $20,000 to do a business, you put $20,000. So both of us take the risk to go put $40,000 as an investment. That's money. So if you die, you can affect my $20,000. If I die, because I'm not there to do my part, or you're not there to do your part, so you're gonna affect each other money. So therefore, we have insurable interest unto each other. So, but the business have to exist at the time of the application for their insurance. So insurable interest must exist at the time of insurable interest. Let's say, for example, let's say back to the first example, husband and wife. Let's say that you plan to get married tomorrow. If you and your honey bunny need to get married tomorrow, but don't say, oh, since we're gonna get married tomorrow, why can't we do the insurance today? Well, you didn't do the court yet to do the wedding, to sign those court documents so that you are legally married. So therefore, you cannot do the policy today. You have to wait when you go to the court, sign paperwork, then you official, then you guys married, then you can put an insurance into your husband or your wife. That's when it's official. So same thing for the business. So you have to exist at the time of the application. So the right answer for this one will be this one here. Okay, that's the long one. So that's the right answer. See, hopefully that's helped you guys out. Next, let's clear this out. Clear. Okay, so now next question. What is the term for how frequently a policy owner is required to pay policy premium? So make sure the keyword is frequently pay premium. How frequently to pay the premium? Now, frequency means how often. I could take that out. How often? Okay, how often do you make the payment? So now, one mean is a consideration. Well, consideration, I understand that premium, when you pay premium, is part of the consideration, but that's not what this question is asking. Okay, the question asking how frequently you make the policy and pay the premium. How often? Is it the mode? Oh, that sounds like it. How often? The mode. The mode. How often? Mode mean how often. Schedule. Nah. Schedule doesn't mean how often. Schedule tell you when to pay, but it's not saying how often. Grace period. What? Grace period have to do with anything. Grace period is the day that you have to pay your policy for free. Grace. A period. Time. A period of time. They give it to you. Grace. No, for free. So they didn't have to do it. They give you a favor. So we could eliminate this one, eliminate this one. We can also eliminate this one. So the only right answer here, if you look, we eliminate all this, only one left, mode. So therefore, the answer to this one is mode. So how often? How often? If I could put how often. That's called the premium mode. That's why they call it the premium mode. How often do you make the payment? The premium mode. Okay, that's the answer to that one. All right, so let's clear and let me go next. So next question. Next question said, an insured pays $100 premium every month. Every month. Now remember that $100 every month for his insurance coverage. Yet the insurer, that's the insurance company, promises to pay $10,000 coverage. I mean, cover the loss. Okay, to cover the loss, excuse me. What characteristic of an insurance contract does that describe? Okay, now they give you a scenario. Okay, somebody pay $100 for 10,000. The question is to ask, does $100 equal 10,000? Why would you pay that little money for this big chunk of money? So that's when they're not equal. So now the keyword is, if they're not equal, if 100 doesn't equal 10,000, so that what is asking, what type of contract is this? So remember, a Haitian contract means take it or leave it basis. So we know for sure it's not a Haitian. So I could X this out. It's not a Haitian contract. Take it or leave it basis. If there's a mistake, so either you accept it or you reject it. That's a Haitian contract. Conditional. What does conditional mean? If this happen, this will happen. If you're within this question, does it have any if on it? But instead of if, you say yet. Yet doesn't mean condition. So it's not this. It's not conditional. So the contract, that's not that. Now, what is aleatory? Aleatory, that's true. Aleatory means exchange of unequal value. Exchange of unequal value. So what I pay for, I exchange it for a value that's unequal. So what they're gonna pay me will never equal to what I paid. So that's what I mean. Exchange of unequal value. Good health, that's not part of the game. So the correct answer for this one is this. So if I just click that to make it better for you. So here, the answer is C. So aleatory. Aleatory, so insurance or aleatory contract, that's mean exchange of unequal value. So what you pay, either you got more or you got less. It will never be exactly the same amount that you pay. So that's unequal value. That's called aleatory. So let's go to the next question and let me clear. And I'm pretty sure this is the last question we're gonna do. Okay, that's question 10. That's the last one. This question asks, which of the following is true about credit life insurance? So that's mean one of them is true and the rest is false. That's what it's asking. One is true. So one is true. Only one of them is true. Everything else is false. So now, but what is the keyword? Credit life insurance. Credit life insurance. That's what is it. Credit life insurance. Those are the keywords. So now let's go ahead with A. Debtor is the annuitant. So annuitant, this is life insurance. So we're not talking about annuitant. So that's not good. Annuitant, that's for annuity. So this life insurance. So A is eliminated. So let me just do it just on the letter to make it better. Eliminated. You X this out. That's not you. Okay. Next, creditor is the insured. Creditor is the insured. No, debtor is the insured. That's not a good statement neither. That's not you. Okay. The creditor is the policy owner. That makes sense. C says debtor is policy beneficiary. No, that's not true either. Because the creditor is the beneficiary. Oh, the last one, let's clear this out because we know. So if that's when there's only one left. So the answer would be this. Creditor is the policy owner. Yes, the creditor is the policy owner. They're also the beneficiary, but the debtor pay for the policy. How do they pay for the policy? Why they're making the debt payment? They include it into your payment and your debt. If you have a car payment, when you make that car payment, it's part of it. If you have a mortgage, it's included in your mortgage. That's called creditor life insurance. So that's how we're gonna conclude this session. Hopefully you are paying attention. Take good notes. If you like this, that's the first time I just do random 10 questions because it's been in my mind. So I didn't get a chance to do it. So I'm glad you are paying attention to those 10 questions. If you find them in your exam, you can nail them down and know how to take your time and answer those questions. May the best player win. And I see you guys at the top. Good luck.